Good morning, Michelle. Welcome again to Blue Notes. Thanks for talking to us. It's the bank's interim result today, a strong result. Return on equity improved. So what were the key drivers there?
Hi Andrew. Yeah, so return on equity was up 130 basis points on the same time last year. And I'd really put it down to three things. The first is the continued rebalancing we've done in our portfolio by reducing the risk-weighted assets in the institutional business and also improving the profit in the institutional business. So credit risk-weighted assets reduced by around $9 billion in institutional, and there was a significant increase in profit. The second point I'd highlight is productivity. We've really been focusing on productivity across the group, and costs are down 1.5% on the second half of last year. Both of those things that I've spoken about, they're things we told you we were going to work on, and we've really worked hard at them. On top of that, we've also had the benefit this half of lower provisions. Provisions were around $300 million less than they were in the second half of last year.
Well, it's an interesting point that because there is talk of stress and anxiety in the economy. So can you talk us through the credit environment? And the losses are down almost a third this year.
Yeah, so almost all of the change was in the institutional business, and certainly that's been the case, partly from our own actions and just partly the way credit quality has performed in the business. Across our other businesses, I would say it's been broadly the same as it was in the second half of last year.
And when you roll together these strong results, one thing we've seen is strong capital generation. Core capital is above 10% now. So what does that mean for the business going forward with that capital there?
Yeah, so our core equity ratio this half was 10.1% at the end of March. That doesn't include any impact from the divestments we've announced in the last few months. They together, over say the course of the next year, will add another 65 basis points once they complete. As we look at our capital position, we're pretty pleased with where we are. We feel it's given us a lot more flexibility for the future. Having said that, we started the discussion talking about ROE, and having more capital actually has had some negative impact on ROE, but it does give us more flexibility for the future.
So with that strong capital generation that you've been talking about, the dividend was stable, but does this start to introduce the opportunity, whether it's higher dividends or other capital management strategies?
So we feel right now that we're in a great position. We have a lot of flexibility. What we don't know yet, so firstly we haven't been paid for any of the divestments that we've announced. They're subject to regulatory approvals, and that will happen as they complete. We also don't know what changes APRA might make in relation to the banks being unquestionably strong, but we do feel in a really good position to be able to deal with that and to have a lot more flexibility going forward.
And there has been a shift in capital allocation, which is something that in the result has been sort of called out, and more capital is going into the retail and commercial business, less into the institutional business. Is that a cyclical thing, or is that a sort of permanent shift in the bank?
So for us, it's two things. It really is a permanent shift. So we needed to have less of our capital allocated to institutional and more to the retail and commercial businesses, because that in itself would drive better returns. On top of that, we needed our institutional business to improve returns within it, and both those things are happening, and that's what I spoke about at the start in terms of one of the drivers of our ROE improvement this half. In terms of where we go from here, I think we've still got a bit more work to do, particularly in the international business. Australia and New Zealand are probably getting a bit closer to the target, but we've got a bit more work to do over the next 18 months.
One area where there was some pressure is on margins, or continues to be on margins. What are the moving parts with the margin picture?
Yeah, and you talk about moving parts because you've got to look at margins in terms of different components. 2/3 of the impact on margins this half was in Treasury and Markets. As I look at margins overall, I almost split it between what are the things we've done and what are things going on in the market. And for us, it's probably been a bit more of the former than the latter. If I talk about what we've been doing this half, we made some conscious, deliberate decisions to strengthen our balance sheet and also to improve risk-adjusted returns, but they impact margins. On top of that, market conditions are pretty competitive, and I expect that to stay the case, although recent asset repricing in Australia and New Zealand hasn't really come through over the course of the first half.
Thanks very much then again, Michelle, for speaking with Blue Notes.
Thanks, Andrew. Great to chat.